Okay. All right. Now, I think everyone is here. Good afternoon, good evening, or good morning, depending on where you're joining us from. And welcome to another episode of the iFlip Mailbag, brought to you by the iFlip YouTube channel. Today is our October session of this monthly show. I'd just like to say welcome back to everybody, because we did skip the September session of the Mailbag show because we were in Dallas doing the Bulletproof event. And so welcome back, everyone. And joining me, of course, is none other than my co-host, Lee Gearhart, Director of Sales at iFlip. Welcome, Lee.
Thank you. Good to be back.
Now, we have a bunch of questions tonight because we are a little bit backed up. As I just said, we did skip the September episode of Mailbag. So let's just jump right in. We have more questions than usual tonight, and we're just going to fly through them. And as always, everybody, the people who have showed up live obviously are the number one priority. And if you have any questions you want to throw into the chat there, just let us know. This is more of more interactive usually than the AI circle is. So feel free to throw your comments and your questions into the chat. Live chat in the comment section down below, and we'll get to them by the end of the show, I promise. Okay, let's start with the first question. First question for tonight is, I hear Kelly talk about how we're out of the market in most things. When I look at my account that has conservative and red oil, those are two different smartfolios, I am almost fully invested. Can you explain? Now, Lee, I know you're not Kelly, but I know that you've had this conversation quite a bit before. What have you encountered, and what are your comments on this?
Yeah. First, I would like to get his response because I think it comes down to one word, which is, or I guess two words, the market. When and this is my interpretation, but when I hear him say like we're out of the market, I think we don't own the SPY or the S&P 500 ETF. So I think that's what he's saying, which that ETF is definitely in a lot of the portfolios. I want to say it is in conservative, and that's one of the two things that we're not invested in that conservative portfolio. Red oil is 100% invested. There's 4 oil or energy stocks in there, and we own them all right now. The one thing those two both have in common, and you can even have this spill into the balanced portfolio as well, is a lot of the companies that we own right now are typically a little bit more stable, and they also pay a dividend. So those are ones, at least in my interpretation, those are the ones that we own right now. Whereas, say, the aggressive portfolio, we're pretty heavily in cash right now. We only own maybe 3 or so out of the 11 things inside of that portfolio. So we definitely don't own the SPY unless something changes by tomorrow morning. If somebody watched the replay tomorrow, this could be wrong. But as of now, we're out of the market, which would be out of the SPY.
Yes, let's be perfectly clear. Our comments are as of market close on October 18th, 2023. I think that maybe Kelly and I need to do maybe a little bit of a better job going forward in terms of like the colloquialisms that we use. When we say the market, I've always understood him to mean the S&P 500. For everyone watching at home, iFlip primarily, the AI is primarily concerned with the S&P 500 because that's basically the measuring stick of the US and ultimately probably even the global economy. So that's like the big kahuna, and that's the thing that we're going to pay attention to the most. Most soft smartfolios, I think, have like most of their exposure dedicated to the S&P. All of the different smartfolios that, especially the core ones, have most exposure to the S&P. The additive ones are kind of like, think of it as like side dishes or like toppings to like your main dish. Like the S&P 500 is absolutely the main dish. And if we say like, oh, like your main dish is late or isn't coming, it doesn't mean that the side dishes aren't coming, right? It just means that your like your steak or whatever it is, your main course is just is not there. It's separate. So red oil is one of the specialty ones that is mostly S&P 500 is not in that one, right? It's one of the rare ones that does not have the S&P 500 in it. It is specifically designed for like a oil concentration, energy concentration only, which is why it would deviate especially in a climate like right now in 2023, it would deviate from what we talk about. So we'll do a better job of clarifying what we're talking about. But if you're a conservatives doing great this year. So that's the silver lining.
And just add one more thing. I alluded to it, but on the dividend side of them, those kind of limit your exposure or your risk as well. If a company pays a 5% dividend and the stock loses a few percent, like at least you have that dividend to make up or recapture some of those losses, I guess. So I call them security blankets.
That's great. But the question is for all of you at home, what smartfolio are you invested in? I'd love to know. Please comment down below and let us know what smartfolios or what core strategies and what additive smartfolios are you invested in. Jump down in the comment section below and let us know. Leave your thoughts there. For now, let's move on to the next question. And the next question for this evening is, what is your fee structure above 50,000 all the way up to 10 million? You only show up to 50,000 in assets. All right. So a pricing question, Lee. What do you have to say about this one?
And I actually got this question either last night or this morning. I wanted to get it in there. So this person, I believe, saw our website, or they're just perusing the website. They went to our pricing page, and on there we show the three, what is it? Basically the three lowest out of the 5 different plans that we have. So we have 5 different tiers or plans. All of them, basically the monthly subscription is solely dependent on how much money the AI is managing. So there's different ceilings and floors, if you will. As an example, the bottom tier is our $7 a month plan. That gets you up to $10,000. And then it goes up a little bit from there. The 2 tiers we don't show on there, the ranges are between 50 to 100,000 and then anything over 100,000. So 50 to 100 is 97 a month. And then anything over 100 is 147 a month. So the most you'd ever pay is 147 a month. The cool part is that it caps out there at that amount. And whether you have 100,000, 500,000, over $1 million, it stays the same amount, which is actually the exact opposite of the AUM percentage based model, if you will. If you're paying, say, 1% and your account goes from 100,000 to $1 million, you're paying a whole lot more in fees when you have $1 million rather than 100,000. So not that the person asked for all those details, but those are the numbers and then some.
Yeah, I'll just jump in here real quick at a couple of comments about the nature of the fees when you get to that level. When you're a millionaire or a billionaire and you hire somebody like Kelly in an institutional kind of like hedge fund or a money manager or investment firm of some sort, they will almost always, I've never seen a single one of them charge the way that we do. Almost all of them, because they make more money this way, they charge you a percentage of the money that they manage for you. So, and it's usually, we use 1% as a barometer, but I've never seen anyone charge 1%. It's always like a minimum of 1.5 or 2%. And then on top of that, there's a profit sharing percentage as well. So there's 2 layers of fees usually when you deal with somebody that is as high caliber as Kelly. When you have AI working for you, when you have 40 years, 4 decades worth of investing experience, Wall Street experience, working for you on your side, you're usually going to pay a really hefty fee. And if you're talking 10 million, since the question asked, 10 million, Well, okay, let's pretend for a moment that it was only 1%. And no profit share, right? Like the most conservative, ridiculous, professional management fees there are, it would still be $100,000 a year for just in fees. 1% of 10 million is 100,000. If my math is serving me correctly there.
Yep.
And on our platform, theoretically, you'd be paying $1,470, like $1,470, because if we have something where if you pay a year up front, you get 2 months off. You buy 12 months, get you buy 10 months, excuse me, get 2 free. So you'd only be paying $1,470, like less than $1,500 compared to $100,000. That's why higher net worth individuals really love this platform. They're getting professional grade in investing and risk management strategy, but they're getting a killer savings on what they would otherwise pay if they went to somebody else as a management fee. So on the lower tiers, you might not notice it that much because it's really in your face, but definitely as your net worth grows, it becomes a better and better deal. Let me see here. Any other thoughts on that, Lee?
No, and we didn't even talk about mutual funds. A lot of people, the typical American, I'm pretty sure, is still invested in mutual funds. So the nice thing about our structure is it's very transparent. That monthly subscription. The only way it would change is if you add a bunch of money to your account or take some out. Then that would affect the monthly subscription for that month. But you can rely on what it's going to be. There's no back end, fees being taken out. We're not paying another advisor or a money manager or anyone along the way to eat at your returns.
Right. And we did get a question just now from Stephanie. Is there a place where the fees are listed? Lee, do you want to take that one?
Yeah. If you're on, I'll find the link real quick. But if you're on our website, there's across the top, right under the login button where you would log into your account, it says pricing, and that'll show you the different options, if you will. I'll send a link in the chat here in a second, though.
Thanks. And thank you for the question, Stephanie. But the question is for all of you at home. Have you done the math on the cost savings between a traditional money manager versus what you're paying in the subscription fee in iFlip? If you've done the math, please let us know how much you're saving. And if for some reason you don't know how to do the math, let us know, and we'll show you how to do it as well. So jump down in the comment section and let us know your thoughts. And let's move on to the next question. Our next question for this evening is, do you have options to automate a cash reserve, whether it be a dollar amount or a percentage of the portfolio? It's a very interesting strategic question here. Lee, I'll let you go first on this one because I think this one is a little bit up for interpretation. So go ahead.
You took the words out of my mouth. I was going to say, I feel like we say this is up for interpretation a lot, but they're so true. It depends on how we understand the question that's submitted, mostly via email or text or something like that. So you don't always get the whole story there.
That's why we have these conversations. Yeah.
I took this as like, basically I'll start with the answer, I guess. Yes, you can have a percentage or a dollar amount of your account always be in cash or set on the side and not investable. Some people that have been with us for a long time might remember the SSP days where you could tell the AI that you only want it to invest 80 or 90% of your account. The way we do it now, basically, I don't know how else to explain this, but when you invest into a smart folio, you designate a dollar amount that you want to go towards that smart folio. So say I have $10,000, I want 5,000 to go into conservative and 5,000 to go into balanced. I can do that. Obviously there'd be zero cash on the side since that whole 10,000 is invested, but maybe I wanted 5,000 to go into conservative, 3,000 into balanced, and I wanted to keep 2,000 in cash. Maybe if I saw an opportunity to buy something, I could have cash on hand. Or if I just wanted to kind of hedge my bets, if you will, in the market and keep money out of the market in cash, you can do that as well. So that's how I interpret the question. You might have interpreted it differently, but that's what I would say.
I mean, I guess it's less about how I interpreted it, and it's more of a suggestion for how I had like to answer this question, how you should be thinking about navigating um, asset and capital allocation inside of our app. And maybe this is, I'm biased because of where I came from with my background, but I really feel like iFlip is essentially a hedge fund in a box. And what you have at your disposal is you have three core strategy, like three main kind of traders. Because if you've ever seen like one of those Wall Street type movies, they're usually like Billions or any of those kinds of shows. You see traders with like in a row and with their desks, and they all have specializations usually. And so imagine each of the smartfolios as like an actual like trader, an actual entity that you assign a certain amount of money to, and then you're like, that's it. Like the amount that you assign to it and you put into the smartfolio is what you give to that trader, and then your hands off. It's up to the trader to perform or not, and then you either keep them around or fire them or something afterwards, right? And so that's how the smartfolios function as well. So if you give a smartfolio 10 grand, unless you change your mind and be like, never mind, I only want to give it 5 grand, you can't really meddle with it. The AI takes over from that point. So the decision comes all the way in the beginning. How much money do you want to give the AI trader that specializes in red oil? How much money do you want to give the AI trader that specializes in big tech? I had to think of the smartfolio names for a second. And how much do you want to put into one of the core strategies? Do you want to invest in all the core strategies? So once you allocate a fixed amount, it's set and forget. That's the experience that we want to give. And Jim chimes in here. I think this is really smart too. Thank you for this, Jim. This is a really smart additional comment. Is Jim he says he always keeps enough cash to cover the fees, more or less. That's really smart too, because a lot of the people in our user base just choose to have the fees taken out of their brokerage account every month. Just before, I was offering the option of paying on a credit card, in advance for a little bit of a discount. If you pay for 12 months, we'll only charge you 10 months worth. But a lot of people choose to do this and have their fees taken out of their brokerage account. So leave a little bit of cash, I guess, for that. Otherwise, set and forget, assign a fixed dollar amount. AI takes care of the rest. Okay.
And Jim, you could always, like Aaron alluded to, you could always put those fees on a card or something outside of the account, so you have more money at your disposal to work for you, and also compound and grow. So even though we have to pay the card processing fees and all that, it is in your best interest to do it on a card. So
that's that's like a whole separate video in and of itself.
Yeah.
When you do the calculation of the fees paying outside of your investable funds versus inside of your investable funds, it adds up very quickly. So that's a whole other topic, though. Thanks for the comment, Jim. We always appreciate your engagement and participation. Let's move on to the next question, which is, can you split assets into multiple accounts automatically to get the FDIC, and there's a little bit of a typo here, it should be SIPC, SIPC coverage, or do I have to set that up? This is also a very strategic, very smart question. You want to maximize the insurance that the government provides you here. Although I will say, with iFlip accounts, the FDIC insurance is not applicable. It's only the SIPC. But Lee, I'm going to let you expand on that. This is way more up your alley.
So FDIC insurance is really for like banks, and a lot of people have heard of it before, especially back in 2008. Basically, if the bank fails, FDIC insures your deposits up to, I believe it's $250,000, maybe 500. I think it's 250 though. I'm pretty sure on that. What SIPC insurance is basically the same thing, but in the brokerage house world, they'll insure up to $500,000 in your account, and up to 250 of that can be cash. So, I guess it's very unlikely that all the companies that you invest into all go out of business at the same day. But at the end of the day, we are investing into these companies. And yeah, you can absolutely split up your money into different accounts. I do see that sometimes in personal accounts or standard brokerage accounts. I don't really see that in IRAs, because technically you really have one. Say you have a Roth IRA, even if it's at multiple places, the IRS counts that as one IRA. So I don't really see it get split up, at least on our platform, into multiple Roths or multiple traditional IRAs. But I do see it in the standard, individual personal cash account every now and again. So yeah, it's absolutely something you can do. And like Aaron said, take advantage of all the insurances I guess you can get just in case.
Just to be clear, there isn't an automatic function for the iFlip software to do that on your behalf, right? The way that he was asking the question, can you split accounts automatically? That is something that, if I'm not mistaken, you do have to do that manually. Is that right, Lee?
Yeah, nothing like triggers on our end saying, "Hey, your account's over this limit. You might want to think of, setting up another one." But like Aaron said, very, very sophisticated way of thinking.
It's a good way of thinking. I really appreciate the question. It's a really good question. We also got a follow up from Jim, and this is interesting too, Lee. I wonder if you can comment on this. Does it
Yeah.
make a difference if I am investing with IRA funds? I believe he's referring to the fees being taken out of the brokerage account directly.
Oh. See, when we say interpretation all the time, if you didn't say that, I would have answered it in a way different way.
Well,
um,
Jim, if you're here, if you're still with us, you could clarify. But I believe he means regarding the fees being taken out of the brokerage account directly versus a credit card.
yeah, we have. I'll just say this in short: we have people with all different account types paying on cards, so we haven't ran into any issues of like you not being able to pay for an IRA on a card.
Okay.
Um,
Yeah. So it's a subscription service. It's what you're paying for is a piece of software. Whether that software is working on your qualified funds or non-qualified funds doesn't matter.
Yeah,
So
and
it's the
obviously
same amount.
we're not accountants by any means, nor are we licensed to give you an advice or anything like that on anything accounting related. But I know there are ways, if you have a business, to include this in your deductions as well as a write off. So we're talking
Right.
about sophisticated things. I mean, again, not that our fees are. It's not like you're paying tens of thousands of dollars to us, but hey, every little bit helps. And if you rack up a couple extra airline miles because of it, then all for the better.
Yep.
Just pay them
Those
off.
be- benefit of using a credit card is more than just the savings, right? There are ways you can take advantage of points and other perks and even tax savings. I totally forgot about that part. Yeah, because we're not tax professionals here. We can't give that kind of advice, but it's definitely worth a conversation with your actual tax professional just to see what deductions you can get off of that. All right, let's move. Thanks for the question, Jim. Let's move on to the next question. Do you also automatically rebalance, not just avoid downturns? I think this is a question regarding what the AI does automatically. Do we also rebalance and not just avoid downturns? Lee, what do you say?
Yeah. This is a hard one for me, to be completely honest. I could answer this yes or no if someone told me to. It again comes down to interpretation. Basically, Yes, the AI is trying to avoid downturns. At some points, yes, if you own, I don't know, Exxon Mobil, for instance, and it has a really good month, then at some point, if you had 25% allocated to Exxon, then there might be a point where it's closer to 30 or 35% of that account's balance because it's been doing so well. But if we're black and white talking about rebalancing based on, portfolio A does well, portfolio B is not doing as well, and sell some of A to buy more of B to get back into like a 50-50 balance, then that's not something that we do. The AI, once you sell the positions and then it, reinvest those funds, some of those proceeds that you got from Exxon, they very well could go into a different company to get you closer to that 25% across the board that red oil has. But again, the main thing is to avoid the drawdowns. We want to limit our losses. It's obviously a lot easier to get a couple 2 or 3% back than 19.5 like last year.
Yeah, I mean, when I saw this question, I had a very similar reaction. I'm just going to bring this question back up again. It says, "Do you also automatically rebalance, not just avoid downturns?" And my immediate reaction to this, it was a little bit, it reminded me of the time when I was a kid. I might be dating myself here a little bit, but when I was a teenager, I worked at a store called Blockbuster. I don't know if you remember, if y'all remember what that is, but I used to work at Blockbuster. And I remember I worked during that time when like DVDs came out and replaced VHS tapes. And I remember someone coming to me and saying like, "How do I rewind a DVD?" And I'm like, you don't do that, right? A DVD is digital. Like there's no need to rewind because a Blockbuster was notorious for charging fees for people who didn't rewind their VHS tapes. So it's a valid question. Same thing here. This is a very valid question. However, it's also, in my opinion, in the age of AI, an NA question, a not applicable question, similar to like rewinding a VHS tape is totally not applicable, especially right now in the age of streaming. It's not an applicable question because, in my opinion, the purpose of rebalancing is risk management and uh, efficiency, cost efficient investing. So maximizing your like Sharpe ratio and things of that sort, right? Making sure that you're not taking too much risk and your gains are going to be appropriately risk adjusted. Okay, now that's the purpose of rebalancing, in my opinion, as I understand it, from back in the day before technology was really a thing in investing. Today, timing the market with AI is that it does that way better than any kind of, oh, let me reallocate the pie of my investments so that every slice is an equal percentage. You don't need to do that anymore. We're in the digital age. We can time the market now. You don't need to do that if you can time the market. And our AI has been proven that it can do that. So that's my comments on this. Like you don't need to rebalance. We don't think about rebalancing because we have the superior risk management strategy automated by AI. So, Lee, do you have what do you think about that?
Yeah,
Am I way off base
no,
or?
no, that makes sense. But while we're on the topic of kind of getting in and out of the stocks in the portfolio, I think because again, some people, I recognize a lot of names in the chat that already know this, but for the newer people that might be their first or second time seeing us on here, basically when you're picking a portfolio, I'll keep using the red oil one because it's very straightforward. There's 4 companies in there. Basically, when you're investing into it, you're tasking the AI with, hey, buy and sell these 4 and just rinse and repeat the process. So if he's asking if it'll, automatically reinvest back into that stock when it's the right time to, then the answer is absolutely yes. So you basically, again, we've probably said it a million times before, but you kind of said it and forget it. But you also want to be on things like this in the AI circle to stay up to date with, what's going on in the market and what's going on in the portfolios, quite frankly.
Oh yeah. I mean, if you do extremely well, and let's say you invest $1,000 into a smartfolio, and over time you do really well and it doubles, you don't have to reprogram it to invest with 2,000 now. It'll know how much it has, and it'll buy accordingly with the funds that you originally allocated plus the gains. So yeah, if in that sense you're asking rebalancing, yes, absolutely, it will manage all of the capital that you assigned it with AI. Okay, so we're running out of time here, and let's just move on to our next question, which is, can you set up automatic drawdowns and transfers into a retiree's checking account? I feel like this one is quite simple. Lee, are we able to do this? It looks like, automatic distributions.
Yeah, I took this as like RMDs or distributions. For those who aren't familiar with that, that's in a retirement account. When you get to a certain age, they force you to start taking money out, but also some people want to. That's the whole point of having a retirement account, right? So you have money later on in life to
Mm-hmm.
be able to pay for things. So the short answer is, since I know we're running short on time here, it's very similar to anywhere else. There will be some paperwork to fill out. You'll want to let us know where you want the money to go to. We submit that into the broker dealer, and then that gets ACH to your bank. So no different than anywhere else, I would imagine.
Yeah, that's pretty much an industry standard. Okay, and trivia's coming up, folks. So we have one more question, and then we're hitting trivia. I know we're running a few minutes behind. We just had a ton of questions this session, so please bear with us. Our final question for the evening is it possible to invest in the Start Engine campaign using my self-directed IRA account? This is a really good question. I almost saved the best one for last here. Very, very interesting, very creative kind of a thought process here. Lee, what do you have to say?
Yeah, first off, I put the link to the Start Engine offering in the chat as well. I'm sure all of you have heard of it by now, but if you haven't taken advantage yet, there's still time to do so. Basically, Start Engine is correct me if I'm wrong at all, Aaron, or if I misspeak, but it's basically a crowdfunding platform where whether you're an accredited investor or not, you can own a piece of companies like ours, and they have many others on there. A lot of success stories, and hopefully will be the next one. But the question comes down to, when you're setting up your account to invest into us on their platform, some people have asked me like, hey, can I do this through my self-directed IRA? The short answer is no. They don't have all the different options like we do for account types. They basically ask your name. They do the similar KYC type stuff that we do. And then you say, how much do you want to put into iFlip? And then they ask you a couple other questions. I believe you can do it through a business or a trust, though, as well. So I thought they only had one option. I believe they actually have three. But just to expand upon this a little bit, if the purpose of why you might want to do it in an IRA, like say we knock it out of the park and your investment 10 20x's, whatever that is, if that's in an IRA, say a Roth IRA, where you're never paying taxes on the gains, you just made a bunch of money and it's all tax free. So I think that's where the question stems from. Short answer is no, but it would be a pretty cool thing to be able to do.
Now, there is a very advanced technique if you were determined to do this, right, Lee? Where something called a checkbook LLC
Yeah.
a technique, which is very advanced. Very few people even know about it, but we have the opportunity to talk about it real quick. Even though we're over time here, I think it's worth it. Do you want to comment on that just
Yeah.
a little bit?
Basically, and I'm by no means the expert on checkbook LLCs, but a lot of our, if not all of our self-directed custodians that we have relationships with, I believe all of them offer this. Not to get into the weeds of it, but basically to us, it's a corporate account. It's really a retirement account for you, but it's tied to your business. Say if you're a sole proprietor or something like that, where you offer your own retirement account. Basically, you have why they call it a checkbook LLC is you have a bank account with it and you can invest directly through the bank, just like if it was your personal funds or your business funds. So it's kind of a combination of a couple different account types. The only thing that might be a con to that is that you're responsible for all the reporting on it. The self-directed custodian doesn't do it. So you're indirectly signing up for a lot more work, I think. I can't speak from experience, but
Yep.
I just happen to know. So there are definitely pros and cons to it, but it is something very fascinating that I bet a lot of people don't know about.
Yeah, techniques like that, when I learn about them for the first time, it just blows my mind the creativity that can go into the whole finance world, right? And I think it's so interesting. So you have like a start engine who will only accept that a deposit from a bank, and you have an IRA which doesn't have a bank account, and that checkbook LLC sits in the middle to bridge that gap. However, you're responsible for all of it. So obviously, there's going to be a cost to it. There's a cost to set it up. There's a cost to do all of the paperwork and recording and make sure you're compliant with taxes and all that stuff. All of that goes into that as well. So you have to be really sure that you want to do this and have enough capital to make it all worth it, right? So that's the caveat to that. We're not tax professionals here, as we already said, but it is something that exists that a lot of people don't know about. So do some research on it and jump down in the comment section below if you actually utilize this strategy. Do you have a checkbook LLC that you're able to use via your IRA account, your qualified accounts? If so, let us know what you use it for and how that's been going for you. Jump down in the comment section below and let us know your thoughts there. Now, that's it for our questions for the evening. We do have trivia coming up, and our trivia question today is very interesting. I'm just going to give you a hint that it's not only America is the hint that I'm going to preface this with. And you'll see what I mean when you see the question. Just so that everybody knows, the trivia question, the prize for winning the trivia question is a $25 Amazon gift card. And we will, how do you qualify for that? Well, we'll get to that in a moment, actually. Let me give you the question first so that we can get some answers in there. If you've been watching like passively and just listening to us like a podcast, now's the time to stop what you're doing and engage on your keyboards or your phones or what have you. Let me find this question here. All right, the trivia question for tonight is, how old is the stock market? I don't mean the American stock market. I mean the entire stock market in history. So, as you may already know, America is not that old of a country, right, compared to the rest of the world. So the American stock market is not the oldest stock market there is on the planet. Just that's my hint to you.
Aaron, are you looking for what should the answer be? Should it be?
I'm looking for a number answer. So if you're going to go and research this, you're going to have to do a little bit of math in addition to in order to get the right answer. I'm looking for a number answer. How old is the stock market? The oldest stock market in the world, you can say, okay? And I do have a very specific answer. And if you want to just guess, whoever guesses the closest number first will be the winner. We'll see what kind of answers we get. Why did I bring up this question? Because I think it's important, especially right now. We're at war, and the world globalization has made the world smaller than ever before. It's important to remember that America is one of the leading superpowers, but it's not the only one, and our economy fundamentally depends on many other countries' economies as well, and vice versa. So it's very important to recognize that this is very much, if you're gonna become a sophisticated investor of any means, you want to start paying attention to international stuff, right? Not just the war, right? Not just the drama that you see on the news. Okay, so let's see some of the questions or some of the answers that we have. 1,000 years. 1,000 years, Jim. That was a that was a good guess. You overshot it a little bit, though. It was a good guess. The correct answer, I guess we didn't. I was looking for a number, and I should have been clearer. I meant the actual age, but I guess this will suffice. WWMT submitted the answer 1602, which is the year of the first stock exchange was created. Yes, and then Bobby, Gonzalez, of course, he follows up with the age. Okay, so thank you. So Bobby Gonzalez is our winner. The answer that I had was 421 years old. The Amsterdam Exchange was established in 1602 by the Dutch Indian Trading Company. They were literally trading pieces of paper, kind of like how you might have done when you were a kid with trading cards, and you could buy and sell those pieces of paper. And that kind of gave birth to the idea of like, okay, we can do a business just selling shares of paper that it represent ownership of a company. So that's Bobby Gonzalez is our winner. So what do you win, Bobby? Congratulations to Bobby. You're our winner. Now, what do you win? It's a $25 Amazon gift card. How do you redeem this? Well, it's not enough that you got the correct answer, although we congratulate you. You also have to show us that you're invested in at least one smartfolio on the iFlip app. And how do you show us that? Well, just send us a screenshot or your account number to mailbag@iflipinvest.com or text us at 480-418-0585, the number you see on your screen there. Your choice. Once you let us know that you validate your account, essentially, showing that it's invested in at least one smartfolio, we will email you an e-gift card from Amazon. And you'll also have an opportunity to double that if you post about your winnings here on your personal social media. And we'll follow up with you on instructions on how to do that as well. So that's it for tonight, everybody.
Yeah, Jim had a good question because I think from AI Circle, when no one got the question right, I think he was saying next AI Circle, there's going to be 2 winners, or was the prize double? I forget about that.
That is true, Jim. Okay, that's absolutely true. But we're gonna wait until Kelly's here to do that because it was Kelly's question that stumped everybody.
And he wants to do it again.
And we're gonna see if we can do a better job of making it a more feasible question. And he wanted to be there for that. So yes, absolutely. Next, that's a great way to sign off, I guess. Thank you for that reminder, Jim. Next week, the trivia question is going to be $50, a $50 gift card, because there wasn't a winner last week. Kelly came up with a trivia question that was just too good. It stumped everybody. We had no winner, and we're going to double up the prize for next week. So make sure you stay tuned. If you like this kind of content, make sure you hit that subscribe button and make sure you hit that notification bell because you do not want to miss the double trivia prize that we have in store for you next week. That will be Wednesday, October 25th for the second October session of the AI Circle right here on the iFlip YouTube channel. I think that's it. We don't have any other questions, I don't believe. So until then, we're going to say good night. We're going to sign off, and we will see you next week, everybody. Good night.